what happened at that point in time would have been accompanied by a liquidity squeeze, a market event like 2008, it would have been game over. If you would have seen credit restricted in the futures market against good delivery failures, in the cash market, it would have been game over. I had anticipated that the silver market was broad enough that it could accommodate our demand in almost any size. And while the silver market is very, very, very broad, the silver market was then, and I would suggest is today, much more liquid, or much less liquid than you believe. While there's a lot of supply in places like private ownership by the Indian peasantry, that isn't good delivery silver. And in the case of the Sprott Physical Trust, we could only buy silver that was, in the LBME or in the COMEX good delivery form.
Right.
And we were having days when there was $50 million of inflow into our physical silver trust. No problem, says Rick. We clean out Toronto. Okay, we go to Montreal. Clean out Montreal. Interesting. Well, no problem. We go to Chicago. We clean out Chicago. This is becoming concerning. The market's front-running us. We go to New York. We clean out New York. It turned out that London was ultimately able to accommodate us. But London wasn't able to accommodate us overnight, which is what we were used to. We were used to buying silver and having the silver go from somebody else's pile in a vault,
right,
through a screen to our pile in a vault. What happened was that we cleaned out all the piles until we ran into the final piles in London and Zurich, which accommodated us. I actually think that the young adherents to the silver squeeze were onto something. I think their problem was that they bought a long-term narrative and they took in short-term tactics. I actually believe that there are imbalances in the silver market, in particular between the physical market and the paper market. And that's what we ran into. There's tons of silver that trades every day in the physical markets. Some days, 100 times more silver transacts in the paper market than exists for good delivery in the physicals market. It was our bad fortune to run into that, literally. Chris said, we got through it, but it contributed to my baldness. But I think that the people who were interested in the arithmetic around the silver squeeze didn't understand that they needed to be persistent and tenacious. In other words, that the unraveling of the dichotomy between the physical market and the paper market could take 5 years to unwrap. And many of the youngsters who were involved in the silver squeeze had a much more limited time frame. They wanted it to happen in 5 weeks or 6 weeks. And I suspect that many of them employed much too much margin. If you're paying margin interest for 5 years, if the event that you're hoping to participate in takes 5 years and you're paying 8% a year, you might not be early, you might be wrong.
Yeah.
If you're an interest payer. And I think that's what some of the youngsters in the silver squeeze ran into. Remember that a lot of the retail participation in the silver squeeze abdicated. They haven't held the silver for 5 years. When silver didn't meet their expectation, they liquidated in favor of meme stocks, in favor of Bitcoin, in favor of some other speculative asset. So 5 years would have involved them continuing to, in their parlance, stack. That didn't happen. They decided to take on the banks, and the banks kicked their ass. Let's get this straight. It doesn't change the equation. What the silver apes hope to cause to occur will be done by the market in the market's own time. It will take place, likely without the apes. I mean, the disconnect between the futures market and the physical market is as broad as it ever was. And the disconnect that we at Sprott faced, which is to say the temporary increase in demand relative to the system's ability to effectuate good delivery supply, is there. And we weren't big buyers. You'll recall that at that point in time, over the course of a year and a half, we probably accounted for $1.5 billion or $2 billion in demand. We were the players because we were the only instrument that took silver out of circulation. The ETFs ebbed and flowed on a daily basis. When the market replaces Sprott, which will happen, that really truly changes the equation. If what happened at that point in time would have been accompanied by a liquidity squeeze, a market event like 2008, it would have been game over. If you would have seen credit restricted in the futures market against good delivery failures in the cash market, it would have been game over. Now, understand that you wouldn't have had a short squeeze like you have in a fair market. The LBMA would have declared something called force majeure, and they wouldn't have demanded settlement in silver. They would have cash settled. And the exchange, would have determined the cash settlement price, just like they did in the tin market. So part of the premise around the silver squeeze, which suggests that we had a fair market in silver, that the exchange isn't controlled by the dealers in the exchange, is false. That notwithstanding, people would have made a lot of money.
Yeah.
Understand, too, that the failure to deliver didn't reflect overall physical inventories in the silver market. It involved good delivery, silver, the silver that is the stuff of the paper futures, and the inventory that is required for responsible investment vehicles like Sprott Physical Silver. Over time, if institutional demand and retail demand for silver continues, what you will see is a dishoarding of informal silver, silver held by living, breathing human beings in the Middle East and in South Asia, and the reintroduction of that silver into the formal system, provided it doesn't happen all at once, provided it happens over time. And I think that this process probably accelerates. You're seeing a conversion of informal silver to formal silver in China, as an example. I think really the possibility for a cataclysmic break really has to do with how rapidly the market would be challenged. We were a catalyst that challenged that market, Chris. And to be honest with you, a fairly small catalyst. The fact that $1.5 billion or $2 billion in net buying had that dramatic an impact on the physical good delivery silver market let me know just how leveraged the futures market was. There is certainly a deficit. Understand that the fabricators, the people who are making silver panels, don't need LBMA good delivery silver.
Right.
They could care less. They are not fiduciaries storing it on behalf of third-party investors. They are people who are using metal for its reflective property. And to my knowledge, there is no major fabricator that is experiencing delivery failures. The supplies of industrial-grade silver and silver alloys relative to the industrial demand is very much intact. That's still a very robust market. I think that you're seeing leakage from retail holders because retail holders are bored. They don't need it to make mirrors. And I suspect until you have seen sufficient momentum established by the gold market that generalist money comes in the silver space, that circumstance continues. It will continue until it doesn't. I realize that that doesn't make a very good internet headline, for a video, but that doesn't matter much. Your viewers need to understand that precious metals markets are very much intact, that traditionally a precious metals bull market has the momentum established by the fear buyer, the gold buyer, and at some point in time, when the narrative establishes itself, either because of news flow or some other reason, that silver replaces gold as market leaders. I don't know where we are in the market. Nobody else does either, although some people pretend to know. I just know that this is a question where the answer begins with when, not if. And if that answer isn't sufficient, people should do something else with their money. I think the deficit is bigger than we think it is, because I think the informal supply was bigger than we thought it was. I remember all the way back to the middle part of the decade of the 80s, when Buffett suddenly reported to the world that he owned 15% of the world's above ground supplies of silver, that is to say, reported supplies. And the silver price just shot. That's before you were in the racket, I think. The silver price just shot up and then it collapsed. And of course, all the silver bugs said manipulation, manipulation. That's wrong. What happened is that the Indian rupee fell by 50% in US dollar terms, and the price of silver went up by 200% in US dollar terms. So from the point of view of the Indian peasantry, the price of their silver went up by 400%. And that occurred in conjunction with a bad harvest in India, where the Indian peasants had a choice between keeping their silver and feeding their kids. Well, that was pretty straightforward. And a whole bunch of silver came out of inventory from a place that we didn't know it had been in inventory. The understanding that I have, and it's a very informal understanding, but the understanding that I have with the Gujarati precious metals trading community, an informal community, I call them traders, their government calls them smugglers, is that there has been substantial physical dishoarding of silver that has accompanied the reduction in the exchange rate between the Indian rupee and the US dollar. And I think that the offtake of physical silver from informal hoarders in emerging markets in favor of industrial application has been greater than we believe it is. We can observe it in official sectors. We can observe dishoarding from industrial refiners like Engelhardt. What we don't see is the informal dishoarding that's taken place. And I suspect that the informal dishoarding has been much greater than we believe.